All right, let's jump right into this explainer. If you're managing capital or analyzing commodities, you already know the weekly drill. The CFTC drops the latest disaggregated commitments of traders report, and bam, everyone immediately scrolls straight down to row 3 to see what the hedge funds are up to. But Today, we are going to completely blow up the myth of that dead data sitting right there in the very first row. Yep, we are talking about the producer and merchant category. It's often ignored, usually misunderstood, but as you'll see, it literally contains some of the most powerful, predictive, physical market intelligence in the entire gold sector.
Here is our roadmap for today. We'll be hitting 1, unlocking the producer signal, 2, the producer sentiment index, 3, the fundamental AISC floor, 4, miners versus managed money, 5, historical downturns, and wrapping up with 6, the market extreme checklist.
Okay, be honest. How many times have you heard this phrase? Producers are always short, right? It's the standard market consensus. People just assume producer hedging is this mechanical, boring corporate treasury function that gives absolutely zero trading signals. So analysts just scroll right past it. Well, actually, let me just say it straight. Scrolling past this data is a massive, massive mistake. Section 1. Unlocking the producer signal. So the producer and merchant category, these are not a bunch of financial speculators staring at screens. These are the entities physically pulling gold out of the ground, like your major mining companies, or processing it like the big bullion refiners. Because they actually own the gold in the ground, or they're sitting on massive physical inventory, they are naturally long on the physical metal. These guys are the smartest physical market participants on the planet. And listen, their primary goal is not to gamble on short-term price swings. It's corporate survival. They want to ensure profitability across some pretty brutal price cycles. Which brings us to the absolutely crucial takeaway here. Producer hedging is not some robot running on autopilot. No way. It is deliberate and it is highly discretionary. When these physical experts suddenly increase or decrease their forward selling on the COMEX, they're voting. It's a massive, discretionary vote of confidence, or, a total lack thereof, in current prices. When they sell aggressively, they are basically screaming at us that current prices are too good to last. But on the flip side, when they stop selling, they are signaling that prices are fundamentally just too low.
Section 2. The Producer Sentiment Index. Enter the Producer Sentiment Index, or PSI for short. Just like your standard COT index measures what the managed money is doing, the PSI normalizes this producer behavior against its own 3-year historical range. It takes all that complex hedging activity and drops it onto a clean, super simple 0 to 100 scale. It's brilliant, really, because it shows us exactly where we are in the 4 phases of the hedging cycle.
Let's break down the scoreboard here. If you see an extreme PSI reading between 80 and 100, that means producers are aggressively locking in tops. They are maximally short, which, as you might guess, is a massively bearish signal for the market. Conversely, a reading all the way down near 0, that means they are de-hedging. They're actually buying back their short futures or just letting them expire because prices are way too low to justify locking them in. And that is an incredibly bullish signal. It means the physical market is effectively accumulating. But here's the thing. We can't just look at the raw index in a vacuum. We've got to normalize their position against the entire market using the producer open interest share. If the producer share drops below 5%, boom, we are in a massive de-hedging environment. But if it climbs above 12% and stays there over several quarters, that flags a secular structural shift toward producer selling. Basically, when you combine a high PSI with a high open interest share, you've got a seriously potent warning sign on your hands.
Section 3. The fundamental AISC floor.
So let's tie this back to the dirt and diesel reality of it all. Every single mine operates around a critical number known as the all-in sustaining cost, or AISC. This is literally the cash cost required to pull an ounce of gold out of the earth and keep operations running at current levels. Think of AISC as the industry's ultimate break-even point. It serves as the fundamental hard deck anchor for this entire hedging cycle we've been talking about. And this perfectly illustrates why hedging is totally discretionary. Look at the margins. I mean, if the gold price is sitting 50% higher than the AISC, well, producers have a massive incentive to hedge. They are going to lock in that incredible profit margin all day long, creating heavy bearish pressure. But if the gold price falls near, or worse, below the AISC, that incentive just completely vanishes. Producers simply cannot afford to lock in low prices that guarantee a loss. What happens? It forces them to de-hedge and maybe even cut physical supply, creating a massive fundamental price floor that structurally supports the market.
Section 4. Miners versus managed money.
All right, let's put these two in the ring together because this is where the magic happens. On one side, you have managed money. These guys operate purely on financial knowledge. They're looking at momentum, moving averages, macro narratives, and most importantly, they're highly leveraged. Now, on the other side, you have the miners. They operate on physical knowledge. We're talking AISC models, real vault logistics, actual supply and demand, and crucially, they are backed with patient corporate capital. So what happens when these two groups completely disagree? Well, the leveraged speculators are almost always forced to capitulate first due to margin calls. Meanwhile, the patient capital of the miners, the guys who actually hold the real gold, they ultimately dictate the structural trend.
To actually put a number on this heavyweight bout, we use the Producer Speculator Divergence Index, or PSDI. It's simple. Take the Producer Sentiment Index and subtract the Managed Money COT Index. If you start seeing readings pushing past a positive or negative 0.60, pay attention. You're looking at a massive, quantifiable disagreement between paper speculators and physical producers. And as history shows us time and time again, those are the exact moments that flag massive capitulation events. Section 5. Historical downturns. Let's look at the receipts, because the historical track record here is just flawless. Look at 2011. Gold hits $19-20. Speculators were absolutely euphoric, but the PSI reached a massive 95. The physical market was practically screaming that prices were too high, and they locked them in right before the crash. Fast forward to late 2015, gold crashes to 1,050, dropping right below the AISC for a lot of miners. Speculators were totally washed out, but the producers? They stopped hedging entirely. The PSI dropped to extreme de-hedging levels, perfectly predicting that fundamental floor right before a 30% rally. Even during the massive 2020 COVID dislocation, when gold surged to 2,075, producers aggressively hedged that spike, correctly nailing the top once again. Section 6. The Market Extreme Checklist. Okay, so the physical market's voice perfectly predicts these turning points. But I know what you're thinking. Here is the million-dollar question every quantitative trader wants answered. You see this extreme building, right? But how do you actually time your entry in real time without getting completely run over by the final stages of a trend? Well, here is your literal step-by-step playbook. Step 1. Check the extremes. Is the PSI above 80 or below 20? Step 2. Check the open interest. You want to verify that the producer OI share is either above 12% for a market top or below 5% for a bottom. Step 3. Look for divergence. Check that COT index. Are the speculators caught entirely on the wrong side of the boat? And finally, step 4. Pay attention, because this is the real secret here. You enter when the PSI reverses direction. Actually, let me be super clear. You don't enter just because the PSI hits 80. You wait for it to push above 80 and then cross back below it. That turn is the signal. It tells you the aggressive physical selling or buying pressure is officially exhausted. To make this entirely systematic, because we love a good system, institutional analysts roll all this up into a weekly producer signal score, or PSS. It takes the PSI, the open interest share, and that speculator divergence and blends them into one single score ranging from negative 2.0 to positive 2.0. Think of it as an automated, weekly physical market filter to cross-check your speculative data. If your momentum charts are flashing by, but the PSS is deeply negative, yeah, you instantly know the physical market is actively selling into your rally. Which really just leaves me with one final question for you. You've seen the data, right? You've seen the fundamental floor, and you've seen exactly how the patient capital of the mining industry consistently outsmarts leveraged paper speculation. So now that you've unlocked this incredible structural alpha, are you ever going to scroll past that first row of the COT report again? Just something to think about next time the data drops. Thanks so much for joining me on this explainer.